Hey guys, in this video we are going to learn traditional approach in capital structure. This is the third part of our capital structure video. So if you have not checked our first part and second part of our capital structure, then I'll suggest go and check out that part 1 and part 2 first. I'll give you the link of those videos here and in the description box. So let's check out that videos and then watch this video. So now let's move to traditional approach in capital structure. According to this approach, a firm should make an appropriate combination of both debt and equity to achieve a capital structure which may be called the optimal capital structure. That is why at this capital structure, our overall cost of capital will be minimum. Means we should use both debt and equity share capital in our capital structure to make it optimum according to traditional approach. So let's discuss what are the important points that tells our traditional approach. Our first point is that there should be a mixture of debt and equity in our capital structure. That means we should not neither use exclusively equity nor debt. That is why our second point says that we should not exclusively use 100% of equity share capital in our capital structure. So let's discuss our third and last point that says that it says that the value of the firm increase with increase in financial debt but up to a certain limit only, or you can say a point. Beyond this limit, if you increase your financial leverage, means that in your capital structure will lead to increase in overall cost of capital and value of the firm decline. Means only up to a certain point, if you initially introduce that in your capital structure, then your value of firm will increase. But beyond that point, if you continuously increase your debt in your capital structure, then because interest is a fixed charge, then value firms start declining after that particular point. So let's discuss what are the explanation of this third point in more detail. Here you can see that there are some explanation of the third point that says if you increase your debt initially, then your value of firm will increase. But beyond that limit, if you continuously increase your debt, then your value of firm start declining. This is because of our assumptions. According to traditional approach, our first assumption is that our cost of acquiring debt, means KD, is less than the cost of acquiring equity share capital. It means if we are spending 1 rupees to acquire 1 equity share from market, then we are expending less than 1 rupees to acquire 1 debt from market, because our cost of acquiring debt is less than the cost of acquiring equity share capital. Let's take an example to clarify this in more detail. Here's the example that says that ABC Limited has 1 lakh equity shares of rupees 10 each. Means our equity share capital is of 10 lakh rupees. 1 lakh equity shares multiplied by 10, that means 10 lakh rupees. So it's now 100% equity company, because now we have only 100% equity shares of 1 lakh rupees 10 each, then it is 100% equity company. That is why here our overall cost of capital, means KO, is equal to our cost of equity. Why? Because our overall cost of capital is the sum of cost of equity plus cost of debt. As we know that our cost of debt is nil here, as we only have equity share capital, then our overall cost of capital would be equal to our cost of equity. That's why. Now suppose that a company needs more 10 lakh rupees to expand its branches. Which of the source of finance will be best? Our first option could be that we should use more 100% equity shares, means we should use more 1 lakh equity shares of at the same rate of 10 rupees each to get this 10 lakh rupees as a finance. Or our second option could be that we should use 100% debt to acquire 10 lakh rupees. Or our third option could be that we should use combination of first and second, means combination of equity share capital and debt. And as we know that traditional approach emphasizes that we should use both equity share and debt in our capital structure, so third point will be optimum for our capital structure. So according to traditional approach, we should use third point that says we should use both combination of equity share and debt in our capital structure. This is why. This is because of our first assumptions that says that our cost of acquiring that is less than the cost of acquiring equity share capital. Now, because of this, our first point, you can see here that initially when company will introduce that in its capital structure, the cost of equity will remain same. This will remain same because our cost of that is less than the cost of equity. Even with increase in that, because initially we are increasing that in our company, but our cost of equity will remain same. This is because of its cheaper rate, because cost of that is cheaper than cost of equity. This is our assumption. That's why interest charge on that is not a large enough for real threat to dividend payables or shareholders, because we know that we pay interest on that, but initially our that amount is not so big that threats to company, because interest is a fixed charge. That's why we have to pay interest either we are incurring losses. That's why, but in the beginning our that amount is not so big that this interest will threat our company or our shareholders. That's why in the beginning even we increase that in the beginning, but our cost of equity will remain same because of its cheaper rate. Hence in the beginning both KD and KE remain same. KD means cost of that and KE means cost of equity. In the beginning both this will remain same because our cost of that acquiring is less than the cost of equity. Now, because both KD and KE are remain constant, that will lead to KO, means overall cost of capital, to fall initially. Means when we introduce that in the beginning with the equity share capital, then our overall cost of capital start declining. That is a symbol of optimal capital structure. But beyond a particular limit, if you increase in that, then increase the risk of equity shareholders, because now equity shareholders will think that this company is not suitable now because of its increasing that, because that is a fixed charge then may lead to company to the liquidation. That why as a result, beyond the limit, if you increase your that, then cost of acquiring equity starts increasing. But still, since that is cheaper source of finance than equity due to tax saving on interest on that, because we know that we don't need to pay tax on interest on that. As we can see here, suppose that company earns EBIT of rupees 1 lakh rupees. EBIT means operating income of the company. That's full form is earning before interest and tax. That is 1 lakh rupees. Now, first of all, we have to deduct interest that is payable to debenture holders. Suppose interest payable to debenture holders are 20,000 rupees. So after deducting 20,000 rupees out of 1 lakh rupees, we would left only with 80,000 rupees. That is known as EBT. EBT means earning before tax. Now, after deducting interest, we would get 80,000 rupees. Now, this 80,000 rupees is known as the taxable income because tax is always calculated on EBT. Now, suppose our tax rate is 10%. So, because we have to calculate tax on EBT, not on EBIT, means not on 1 lakh but on 80,000. That's why our tax would be 8,000 rupees. But suppose if we have to pay tax on EBIT, then our tax rate or tax amount would be 10,000 rupees. That's why due to interest on that, we are saving 2000 rupees in the form of tax. That's why KO means overall cost of capital may still go down or decreasing. Even we are increasing our that beyond the limit. If we increase beyond the limit, then only our cost of equity will increase. But because KD is a cheaper source, so KD will remain. But gradually, as more and more debt is employed, the risk perception of equity shareholders will increase. That lead to increase of KE and KD both. As the company becomes more risky to invest in constant and our KO will still decreasing. As more and more debt is employed, equity shareholders will think that this company is not longer suitable to invest. And similarly, will debenture holders will think that in this company our investment is not safe. So both KE and KD will start rising. And as a result, since both KE and KD increase rising, and as a result, since both KE and KD is increasing, that will lead to sharp rise in our overall cost of capital. You can also understand traditional approach through this graph that says that initially when you introduce that in your capital structure, our cost of that will remain constant and our cost of equity will also remain constant because interest is not a big deal in the beginning. But gradually, beyond this limit, as you can see this limit, beyond this limit, if you still increasing your debt, then your cost of equity will increase rising. But since due to tax saving, KD is still cheaper source of finance than equity, so our overall cost of capital beyond this limit is still decreasing. But as more and more debt is gradually employed in your company, that will lead to both KD and KE to increase. But gradually, as more and more that is employed, both KD and K start increasing and KO is also start increasing. So you can say that even if companies start increasing your debt beyond the limit, then KO is still declining. But more and more that is employed, that will lead to increase our overall cost of capital. So we can say that our second stage is the best stage for our capital structure. So we should not use more debt beyond this stage. So we can say that we have three stages: first stage, second stage, and third stage. That is also written here. In the first phase, as you can see here, our KD means cost of debt is constant, as you can see here. In the phase 1, our KD is constant, as you can see here that KD is constant in the first phase. Our KE is also constant in the first phase, as you can see here. And our KO is also constant to some extent, as you can see here. Our KO is constant in the first phase, but up to a certain extent, not fully. In the second phase, our KD is still constant. As you can see here, our KD is still constant in the second phase. But K start gradually increases. Because increase in that increase to the risk perception of our equity shareholders. In the second phase, our overall cost of capital is still declining, or you can say constant. In the third phase, our KD also start increasing gradually. As you can see here, our KD start increasing. K increase at a faster rate than KD. As you can see here, it is increasing. And in the KO, and in the third phase, our KO also start increasing, as you can see here. So we can see here, the second stage is the optimum capital structure. So as we can see here, the second stage is the best stage for our capital structure to make it optimum. So beyond this limit, we can still increase that in our capital structure. But beyond this stage, we should not increase our debt because that will lead to increase our overall cost of capital. Let's learn traditional approach within question. Hey everyone, so this is the question of traditional approach to capital structure. So this question will help us to explain traditional approach in detail. So let's discuss this question. Here we have 7 cases. Case 1, case 2, case 3. Which says that in the case 1 that debt as a percentage of capital employed, that is 0. Means in the case 1 we don't have debt in our capital structure. That's why we have 100% equity in our capital structure because we don't have debt. In this section, in the fourth column, we have a cost of debt in percentage, that is 6. And in the fifth one, we have cost of equity in percentage, that is K. And in the last, we have to find out the overall cost of capital, means KO. We can find overall cost of capital by multiplying cost of debt, means this, with weight of debt, that is this. Means debt as a percentage of capital employed is also known as weight of debt. Similarly, equity as a percentage of capital employed is known as weight of equity. So to find out overall cost of capital, we have to multiply that as a percentage of capital employed, means weight of debt, with cost of debt, and weight of equity with cost of equity, that you can see here. That we have to multiply that as a percentage of capital employed with cost of that, and equity as a percentage of capital employed with cost of equity to find out overall cost of capital. So to get overall cost of capital, we have to multiply weight of that with cost of that and weight of equity with cost of equity. So let's multiply, because in the first case we have weight of that as a 0 and cost of that is 6, plus cost of equity is 11, multiply weight of equity is 100. Because this 100 is in a percentage of capital employed, so we will write 1. And when we will multiply this, we will get 11. You can also write this 11 as a percentage because it is in percentage. But if you directly multiply this with 100 percentage, that is 1, we will get the same answer. Because this overall cost of capital is in percentage. That's why we are not putting cost of equity in decimal. In the second case, we have cost weight of that in 10% and equity as a capital employed is 90%. That's why in the second case we will multiply 0.1 with cost of that is 6 plus cost of equity that is 11 multiply weight of equity that is 90. So 90 means 0.9. So when we multiply this on solve, we will get 10.5. In the third case, we have debt as a percentage that is 20 and that's why we have equity as a percentage of capital employed is 80. So when you solve this, you will simply get 6 that is cost of that multiply by 20 that is 0.2 plus cost of equity that is 11.5 that is here as you can see multiply by weight of equity that is 80 means 0.8. So when you will solve this, you will get 10.4. Similarly, in the fourth case, the weight of that is 30 and weight of equity that's why 70. So when you will solve this, you will get is equal to 6.5 that is cost of that multiplied by weight of equity that is 0.3 and 12 that is cost of equity multiplied by weight of equity that is 0.7. So when you will solve this, you will get 10.35. In the fifth case, cost of that is 7 multiplied by weight of that is 0.4 plus cost of equity is 12.5 multiplied by weight of equity that is 0.6. So when you will solve this, you will get 10.30. In the sixth case, your cost of that is 7.5 plus weight of that is 0.5 plus 13.5 that is your cost of equity multiplied by 0.5 that is cost of equity. When you will solve this, you will get 10.50. In the last case, in seventh case, when you will multiply 8 that is cost of that with weight of equity that is 0.6 plus 15.5 that is cost of that multiplied by weight of equity that is 40. As you can see here, this is weight of equity. So solve it 0.4 and when you will solve this, you will get 11 as the answer because this is 15.5. So as you can see there in these cases, in the case 1, our overall cost of capital is 11 or 11%. In the second case, when we introduce that in our company and our cost of weight of equity decreased to 90, then our overall cost of capital decreased to 10.5. Similarly, in the third case, when we introduce more that is 20% and our cost of equity then remain 80%, then our overall cost of capital decreased to further that is 10.4. In the fourth case, when our weight of debt is 30 and our cost of equity is 70, our overall cost of capital declined further, that is 10.35. So as you can see here that as much as we are taking that initially, our overall cost of capital is decreasing. But in the fifth case, our cost of weight of that is 40 and weight of equity is 60 and our overall cost of capital decline further that is 10.30. But in the sixth case where weight of that is 50 and weight of equity is also 50, your overall cost of capital start increasing that is 10.5. And in the last case where you take weight of that 60 and weight of equity 40, then your overall cost of capital increase further, that is 11. So you can see here, when we initially introduce that 10, 20, then 30, then our overall cost of capital start decreasing from 11 to 10.5, 10.4, 10.35 till fifth place or fifth case, our overall cost of capital decreasing continuously to 10.3. But when you take as much as that in your company, so your company become risky and your overall cost of capital start increasing, that is 10.5. And in the last case, your overall cost of capital increase further to its original place, that is 11, from where it is start, that is 11. So this is traditional approach that says if you initially introduce that in your company, then your overall cost of capital start decreasing. But if you continue taking that in your company, then your company become risky and your overall cost of capital start increasing further again. So this is all about traditional approach of capital structure. I hope you have understood everything in this capital approach. Thank you.